Good morning and welcome to Star USA Training. Today is April 21st, 2020, and I'll be your instructor. Today's topic is USMCA versus NAFTA. We'll go through a quick introduction on what USMCA is, followed by some of the standards and practices that I think everyone should fold into their awareness, and then we'll have some time at the end for question and answer. USMCA stands for the United States-Canada-Mexico Agreement. You'll notice in the bottom right corner of some of the slides, there'll be a link when the presentation is sent out after the webinar. You'll be able to click that link and access the full text or the other sources that I'm citing throughout the course of this webinar. All right, high-level baseline. The NAFTA agreement was used as a starting point for renegotiation. The point of the USMCA was to strengthen, modernize, and update many of the legacy provisions of NAFTA. So those of you that are familiar with NAFTA should not be overly surprised by anything within the USMCA. It uses the same fundamentals to create its constructs. It's known by a lot of different names, NAFTA 2.0, the new NAFTA. In the US, we call it the USMCA because the US comes first. In Canada, they call it CUSMA. Or in French provinces, they call it the ACEUM. And in Mexico, it's called the TMEC, which is the treaty between those three countries. As of April 3rd, all three countries have ratified the USMCA, and it is planned to go into effect, and it is intended to replace NAFTA. Real quick before we move too deep into that, the words replace NAFTA is still a little uncertain. Article 34.1 of the USMCA indicates that all parties shall make appropriate arrangements to grant NAFTA claims after entry into force of this agreement. There is some uncertainty on whether that only applies to shipments that occurred before the entry into force, or if it will apply for an extended period. We are awaiting guidance from the US Trade Representative. It should be notable that in US law, it is possible for both NAFTA and USMCA to exist. There is a House bill, HR 5430, which talks about the USMCA Implementation Act, but it does not replace or repeal 19 USC 3311 or 19 CFR 181, which are the legal representations of NAFTA within current US law. So absent advice to the contrary, the operating presumption is that NAFTA claims after the effective date will still be viable. We do expect advice to be coming within the next several weeks prior to implementation, but we don't know exactly when or how that is going to be conveyed. So what does entry into force mean? A couple of key dates that we need to pay attention to. The agreement states that the first date of entry into force will be the first day of the third month following the last notification. The last notification has occurred. It was the ratification by Canada and the communications that ensued after that. However, due to the coronavirus complications, there's a delay at least until July the 1st. We're still waiting further advice on whether or not July the 1st is going to be the actual go live date. That is not set in stone, but that is the current rumor mill. We expect to hear advice within the next couple of weeks on whether or not they're going to be extending it beyond July 1st, or if they'll be extending a mutual NAFTA / USMCA implementation period beyond there, or how that's going to work. The agreement is set to terminate 16 years after the date of its entry into force. So that would be 2036, according to the current timeline. Unless both parties or all parties wish to continue the agreement for a new 16-year term. On the 6th anniversary of each renewal, so that would be 2026, each party must confirm it wishes to extend the agreement for another 16 years. If not all parties elect to renew, there will be a joint review session annually throughout the term of the agreement. So 6 years in, they will meet and decide if they want to extend for 16 more years. That would then trigger a 6-year renewal period from that point. If they do not all agree, then everybody leaves the table and they come back the next year. And they will do that for the next 10 years until the end of the agreement. So that the likelihood of there being a political battle for the next 10 years, 10 to 15 years, is actually a lot higher under NAFTA than it would have been otherwise. And as all of you know, I'm sure, the negotiation process was highly politicized. Many of the focal points at the federal and administrative levels have industry-specific impacts. The previous NAFTA arrangement had several industry-specific impacts, but they were not nearly as detailed or widespread as the USMCA was, and that's a bit of my opinion on that, but we're seeing a lot of people lobbying for attention to their particular interests. For the first time in a trade agreement, we have small and medium enterprises represented. There is a specific section of the USMCA that addresses small and medium enterprises. Makes it a little bit easier. There is a DeMinimis threshold for when duties won't even apply for small and medium businesses. That's about $117 US for Canada and Mexico, or Mexican equivalent of $117, a little bit lower for Canada. But under that threshold, no NAFTA or no USMCA needs to be claimed. There are specific provisions for agriculture, automotive, textile and apparel, and telecommunications. And there were key developments in several sectors, including intellectual property, digital trade, de minimis provision, investment in financial services, and the environment. On the digital trade front, effectively, it ensures that no duties will be assessed on electronic goods, goods that are traded over the internet. This is obviously a new territory, but for the 3 countries, that will not be a dutiable product. We're not going to go into a lot of detail on the individual provisions for each of these industries or in these key sectors. I wanted to leave time for talking about the practical applications, but absolutely please send your questions after this webinar, or if you're watching this at a later date, feel free to send your questions in to train@startstate.org, and we will pay attention to those. The agreement also has several side letters throughout near the end of the agreement in section C. The side letters are a baseline for either a clarification or a slight deviation or a particular circumstance that applies to only 2 of the parties. And the US side letters are identified here. If your industry is impacted by any of these things, most notably section 232 or the auto safety standards, you should make sure that you read those side letters to have an understanding of what the agreement was between the 2 countries. Okay, so we're going to try and get into the standards and practices. We're going to be looking at some of the rules of origin and the origin procedures. There's a lot to cover in USMCA, and I'm not going to go into every single detail, but I am going to try and give everyone on the call today a little bit of a sense of how this is going to work in practice. It's important to recognize that it is not exactly the same as it was under NAFTA, but most, if not all, of the lessons that we followed or that we applied under NAFTA are still going to be in effect here today on USMCA. So the way that we approached qualification, the way that we approached record keeping, the way that we approached collaboration with our customers, with our suppliers, with the internal departments, all of that still stands. Those of you that attended my previous NAFTA webinars can refer back to those to look at some of the tools and tips and tricks that I shared. And I'll probably do another session similar to that for USMCA later on in the year as the specific advice gets out there from the US Trade Representative. But for the purposes of today's webinar, we'll talk about the Annex 4B, some product-specific rules of origin, some of the de minimis changes, as well as some of the Section 6 and 7 chemicals and plastics rules that are new to this agreement. We will not be covering value and accumulation, the intermediate and indirect materials rules, the sets of goods and kits, or the automotive goods appendix. It's too complex to dive into, and it's very, very HTS specific. I know some of you have asked for specific information on that, and I will happily work with each of you individually. But for the purposes of this informational session, I'm going to steer clear of the automotive. All right, some of the product-specific rules of origin. It's important to note that the regional value content methods, the RVC calculation methods, have not changed. It's the same formula as it was before. The thresholds, however, may have changed substantially for your products. So here's an example under heading 405. Under NAFTA, it was 60% transaction value or 50% net cost method. Under USMCA, the threshold is 35% transaction value or 25% net cost method. There are a lot of variable RVC thresholds across the entire Section 4 rules of origin. I would encourage those of you that are that are responsible for determining NAFTA eligibility today, familiarize yourself with the new rules under USMCA for your specific products. We have a lot of tactics that we've developed for our clients to prioritize and identify the key factors. I would encourage everyone to do the same thing. Read the rules, especially considering the notes that exist at the section heading and tariff item levels. They have notes interspersed throughout the rules of origin, and they can appear at any level that will either change the interpretation of the rule or will point you in a different direction towards another section of the agreement that you have to refer to first. It's a little bit more complicated if your products fall under one of these areas where you have to cross-reference other pieces of the agreement. But as I'm seeing, as I'm going through these rules, it's actually allowing you a more likely chance of qualifying under the USMCA. That's a very broad generalization. But by and large, most products will be easier to qualify to some degree for the ones that did change. A lot of products didn't change much, or they decided not to have quite as much differentiation at the subheading levels, and they kept a lot of stuff at the heading levels, and they just normalized all the rules, which does actually make it more consistent when applying to your product base. The automotive rules have changed dramatically. Questions on automotive will be fielded in another session or on a one-on-one basis, so we can tackle those as they surface. But those of you that are in the automotive industries, there is an entire section as an annex posted at the end of the agreement. Definitely look at that. It's at the end of Rule 4 or Section 4. Make sure that you go through that entire thing and look for your headings that are in there and read the notes in particular. Okay, the DeMinimis threshold. So the DeMinimis threshold increased from 7% to 10%. That's actually quite a substantial change. The way this works is the value of all non-original materials used in production that do not undergo the required tariff shift. And if it's not more than 10%, then you may ignore that content, provided all the other requirements are met. So when you look at the total value of your goods, if you've got 8% of your good that does not meet the tariff shift, but everything else still qualifies, you can actually get your good in, whereas under NAFTA you could not before. So that's a pretty substantial change, especially for people that are using exclusively tariff shift, but they have some mixed content. Paying attention to that threshold is going to be one way to get your goods to qualify. All non-originating values must be counted prior to calculating the RVC. If all the values are below 10%, the de minimis rule may be used. So you have to count everything, even if it does meet the tariff shift, or so before you calculate the ones that don't meet the tariff shift, you have to include all the ones that do meet the tariff shift. That's an error that I see people make with de minimis quite often. They only focus on the non-originating, but you get to count all of the ones, even if they meet that shift. There are exceptions to the rule as an appendix to de minimis, chapters 1 through 27 in particular. Make sure you hit Annex 4A for your HTS. Don't ignore Rule 4A-K, where it identifies that any non-originating material that does not change at the subheading level may not be counted. So, and that applies to the entirety of those chapters. Okay, Sections 6 and 7, chemicals and plastics. There are new rules at the top of Sections 6 and 7, and these are the only sections, Section 6 and 7 of the HTS within the rules of origin. So Section 6 and 7 covers chapters I can't think of off the top. I think it's 28 through 40, basically. These rules are specific to these sections only, and these are the only sections that have these rules. The way these rules are applied, if you satisfy one of these rules, your good is originating. If you do not meet one of these rules, then you can proceed directly to the tariff rules at the tariff item level, where you actually look at the HTS number and apply that rule. Those of you that are qualifying for one of these rules are going to need to modify your record-keeping practices to accommodate that substantiation, that evidentiary requirement that USMCA has. So before, where you would qualify a good based on tariff shift and regional value content within these sections, you no longer can rely on a bill of materials to evidence the tariff shift change and the value content calculation. You have to have a production process or a mixing process that helps you meet one of these rules. And the rules are on the right side there. The chemical reactions that are occurring within the territory. If you're purifying, there's special things with mixtures and blends. So it goes through these different options where you can identify one of these broad categories, and if your good meets that definition, consult with the engineers if you have to, then your good is going to qualify regardless of what the tariff rule is for that specific HTS number. And this applies to all products categorically within those two sections of the HTS, section 6 and 7. So that's a big deal for people in the chemical and allied industries. So chapter 5 goes into some of the origin procedures that we need to identify and how we make a claim, how we're going to substantiate a claim, and identifying what the data elements are going to be for the certifications that we're going to use. We're not going to get into a lot of depth on the obligations for importers and exporters, errors and discrepancies, record-keeping requirements, denial of claims, or refunds after importation. The general presumptiveness that what stood in NAFTA still stands under USMCA for these areas here. Record keeping is 5 years. Refunds after importation, you have 1 year post-import to make your claim. Denial of claims is going to go through a similar process where you must allow them to come visit, or if you deny them, them being a foreign customs administration, when they request to come visit your premises, if you deny that visit, they can deny the claim for NAFTA. So those things still stand, and that hasn't really gone away. So a lot of the risks are still the same. There's no new penalties introduced from USMCA. It's still up to each country to maintain their own penalty keeping. US has its own set of rules that are in 19 CFR that would apply to errors on NAFTA or USMCA alike. Okay, so claims for preferential treatment. And I apologize for the glut of text here, but I wanted to get all the bullet points together. And I want you guys to be able to use these slides as a reference point going forward so that you can actually tackle these issues using this as a tool. So the importer's claims must be based on a certification of origin, that's different from the certificate of origin, completed by either the exporter, the producer, or the importer. Those of you that are familiar with NAFTA are aware that the certificate of origin, the Form 434, had a very specific baseline on who was allowed to complete it, and did not include the importer at all, and you must be either the exporter or the producer. Now under USMCA, the importer can actually complete a certification of origin. The importers have special proof requirements that are enumerated in 5.2, 2A through D. Pay attention to those if you're going to be making a NAFTA or a USMCA claim as an importer, but that does open the door for a lot more ambiguity with enforcement. I've had experience with people in various countries changing certificates of origin, 434s, to have new dates, things like that, because they wanted that benefit. And we need to be alert to importers alleging that the exporter provided them documentation or things like that going forward, where the standard for making the claim is much lower than it was in terms of getting it approved for duty-free. But the standards for proof are just as high, if not higher, than they were under NAFTA. So the certifications have no prescribed format. There is no certificate, there is no 434, there is no mandated document that you must use in order to make your claims. That is going to present a challenge for a lot of people in a lot of different ways. And we'll go through some of what the data elements that we need to identify on each certificate are. But I think we should be preparing ourselves for increased variance on the certificates, certifications, and needing to interpret and look for all of the elements that are identified in Annex 5A. So that's a new training threshold that we'll have to hit collectively as a trade compliance group. The claims must describe the goods in sufficient detail to identify them, and this is sufficient for the customs administrations to identify them, not for the importer or the producer or the exporter. If customs cannot identify based on the certificate which goods are eligible or not, then it is insufficient. Typically in practice, we use product numbers or SKUs to identify the part that's being described. That would still be effective here. These certification claims may be provided on an invoice or any other document. So directly on the commercial invoice, you can write in all the data elements that you need in order to make the claim valid. By write in, I don't mean actually writing it by hand. I mean ensuring that all those data elements are provided on the invoice. For some companies that have virtually exclusive trade with within North America, that may be a viable way to go. For a lot of companies that don't have that same limitation on where you do business, it may not be practical to change your systems to print different invoices depending on where the destination is or if it qualifies or not. The certification may not be shown on an invoice or other commercial document that is issued to an entity in a non-USMCA country. I've seen a lot of times where a foreign country outside of the territory of North America, Bolivia, Uruguay, South America, anywhere down there, they'll purchase the goods and they will have them shipped to their production facility in Mexico for it to be further processed. The goods do qualify for that crossing into Mexico, but the commercial documentation will indicate a foreign country as the ultimate buyer. So you need to be alert if you're putting that claim onto a commercial document, if the buyer is identified in a foreign country that is not US, Canada, or Mexico, the claim will not be valid. You can also use any language to complete a certification of origin. Spanish, English, French, all those apply, but be aware that you may be required to show a translated copy to customs upon request. So start to get prepared mentally for different languages on the certificates and what sort of communication you're going to have with your suppliers in order to get the version that you need, or what sort of communication you're going to have with your customers in order to provide it in a language that they need. Electronic certificates with digital signatures are valid. This is a key change. Many of us have shifted towards producing the Form 434s electronically, but previously we would need to either hand sign them or have an image signature embedded on them. The image signature technically was not valid. Those of you that have the software to do so, digital signatures, which is not just a picture of your signature, it's actual certifications on the document, usually PDF, provided by a certificate authority. It's a little bit technical from an IT side, but you can now use those digital signatures to certify your claims. And you no longer need to have a blue ink or anything like that on the certificate itself. Okay, so we're gonna go through some of the minimum data elements. There's about 3 slides of this, so bear with me. First part are going to be the identifications. We have to indicate whether the certifier is the exporter, producer, or importer. A simple statement of I am the exporter or I am the producer would be sufficient, but you need to identify who is preparing that certification. And you also need to provide that certifier's name, title, address, phone, and email. The exporter's name, address, phone, and email also need to appear only if it's different from the certifier. So this is in a case where if it's a third-party company that is handling distribution, where they're not the actual exporter, nor are they the producer, then you would need to identify that party. The producer's name, address, and email need to show up on the certificate as well. If it's different from the exporter, again, you can use various if you have multiple producers. That hasn't changed, or you can provide a list of all of the producers that are involved, or you may use available upon request by the importing authorities in order to keep confidentiality. I'm used to using available to customs upon request. It's a little bit more wordy, but it's effectively the same thing. So that still remains. So you can have just the certifier's name and hit same and same for the exporter and the producer, or same and available upon request by the exporting authorities. And then finally, the importer's name, address, email, and phone. Notably, the tax ID is not identified as a requirement on here, which is an administrative godsend, so that we don't have to track down and identify the tax ID numbers for Canadian and Mexican buyers, and we don't need to provide that initially on the certificate for ourselves either. So that's a nice improvement. And then we move into the products. How we describe the products on that certification is not substantially different than it was before, but it is specific. So I want to go through these data elements so that we all understand. You need to provide the description and HCS classification up to the 6 digits. That's not new. If it's a shipment-specific certificate or certification, you are to include the invoice number. The invoice number, having issued a number of shipment-specific certifications, the invoice number was not generally the identifying number that I was used to using. The PO number or the a batch number, if it's a particular batch of materials being sent or items, would often suffice. Here, they're asking specifically for the invoice number. Those of you that use shipment-specific certifications, particularly in the beginning of the year, should take note of that change. The origin criteria are different than they were, but not for most of us. Preference criteria B, or origin criteria B, is still produced entirely using non-origin materials that satisfy the rules, which is the same as it was. A is still wholly obtained, which those of you that aren't aware, wholly obtained is a very specific subset that basically means that you can trace it back to the earth of one of the territories. I won't go into the specifics of what wholly obtained means. That's a separate training by itself. But by and large, most goods that are not harvested directly from the earth are not going to meet the definition of wholly obtained. And then preference criteria or origin criteria C is produced entirely of originating materials. D gets into some of the technicalities, which I'm not going to go into a whole lot of detail, but there are some separate provisions within D, subsets I, 1, 2, and 3 there. You can still issue USMCA certificates for a blanket period of up to 12 months for identical merchandise to the same that are covered within that same certification. So as long as the claim is good for identical merchandise, you can do it for 12 months. It must have an authorized signature and date. The signature needs to be the certifier's signature. So the person that's making the claim has to be the one signing it. Authorized is not defined within the agreement. So you'll have to make a determination on how a person is authorized to sign it within your organization. But typically it's somebody with knowledge of how the good qualifies, not just that the good qualifies, but how it does. They have the evidence and the date of signature. You must also include this statement verbatim on the certificate. I certify that the goods described in this document qualify as originating, and the information contained in this document is true and accurate. I assume responsibility for proving such representations and agree to maintain and present upon request or to make available during a verification visit documentation necessary to support this certification. The framing of that second sentence is a little bit challenging, but basically it is clearer to the person signing it what their obligations are. And this change I kind of like. It goes far enough to cause the person that is signing this to question whether or not they should be signing it. And in my experience, people would not question that often enough. So that's a little bit of a relief. Okay, so we're going to move into the Q&A portion. We're only about the halfway mark. If we end early, that's fantastic. That'll leave more time, but I do have some pre-submitted questions. So those of you that have questions, I know I didn't go into a lot of detail on those, but feel free to submit those now, and then I will read through some of the answers that I prepared from the previously submitted questions. So we did have a question coming into this of will there be a new form, and I answered this somewhat, but I'm going to give you a more technical answer here. There will not be a prescribed form or format for claims. However, in most cases, it will be easier to provide a separate document instead of altering an existing document. Those of you that generate documents internally using electronics software might have an easier time just having a separate document than including all that information onto an existing one. Importers should expect an administrative or training hurdle on looking for the necessary data elements. Importers and people that are requesting statements from producers. With the format change or the lack of a format, there's going to be a wide variety in types of certifications, where things are located, how they're framed. It'll be a little while before things start to standardize as people get used to making these claims. So be alert to that. One of the other key points is that importers who are making a claim based on a certification provided by the exporter or producer, where that certification is not valid on its face, meaning it's either a bad copy and you can't read it, or the information on there is inaccurate or does not evidence qualification for the USMCA, will only have 5 days to replace that certification. So from the time that they're notified by their customs administration, they have 5 days to go back to the exporter and producer to get a valid certification. Those of us that issue certifications to foreign countries should be aware that the customers might be reaching out to us for a 5-day turnaround time on addressing some sort of error or some sort of inaccuracy on the certification. We should be alert to that requirement and recognizing the impact if we're unable to meet that 5-day replacement time frame. It might be a wise decision to start incorporating a replacement requirement into your contracts, or making sure that you're reading your contracts for a baked-in replacement requirement that would be placed on you by one of your customers. If they require you to replace it within 5 days, or you will be paying the duties, you would want to know about that upfront. Who is liable for the claim? So this circumstance hasn't changed. The importer is still the first person liable. The only change here is that the importer can make the claim as long as they meet the specific requirements identified for proof within the rules there. It may not go past the importer. And under NAFTA, the importer is only allowed to make a claim based on a valid certificate received from the exporter or the producer. So it would always flow up the chain. So if the importer is basing their claim on a certification from an exporter, then that responsibility still does pass up the chain. And you can refer to articles 5.4, 5.6, and 5.8 on some of the details of how that works. But when it passes up the chain, it works basically the same way as it did NAFTA. If an exporter based their claim on a statement from the producer, then the producer would be the next person to have to answer for the inaccuracies, if there were any, or to justify the claim. Are the formulas for qualifying still the same? So the RBC methods, as I mentioned, are still the same calculation-wise, but the thresholds are different across the board for a lot of things. Except for automotive, all the RBC methods that I saw should be lower than 60% transaction value or 50% net cost, or at or lower than. The current NAFTA has fields for HS, origin, preference criterion, and net cost. Do these fields remain? So HS and preference criteria, which is now called origin criteria, you heard me trip over that several times today. Those are specifically required on the list of data elements that are necessary. You should always include your origin as well for other import reasons, just to simplify things. So HS, origin, and origin criteria are still there. Net cost is not called out as a specific requirement on the forms. So we no longer need that no or NC to indicate whether we used the transaction value or net cost method. So I think they removed that because it was a point of confusion for a lot of people that were completing certificates, and they would often put a price point in there, when in reality the method wasn't particularly meaningful in the grand scheme of what NAFTA was in terms of enforcement. Can importers still request statements from exporters or producers? Yes. The answer to that is yes. Importers are still required to produce evidence to substantiate their claims, and the most common method is going to be a statement from the exporter or producer. So the process of asking your producers for statements, asking your exporters for statements, your customers asking you for the certifications, that process hasn't really changed. We're still going to be living in that environment where we need to have the entire production chain identified and have the content thresholds identified, the countries of origin established for all of our products to meet the tariff requirements. So a lot of those things have not actually changed, but what has changed is the level that you need to reach for your products. Again, they've broadened a lot of the rules so that it's much clearer on whether or not your good is going to qualify. I'm not saying it's going to be easier to qualify them, but it's much clearer on how to qualify them for a broader range of products. All right, and all right, so a couple of questions. Do we have any examples of forms to use? As a matter of fact, yes. We will be producing some standardized forms that we'll be making that encapsulate all of these pieces. And if you're interested in those, send us an email after this. I have a slide on the next slide is actually about that. Will the old NAFTA certificates of origin be acceptable? So the form 434 is not required and should not be used for USMCA claims. The claims under NAFTA may still be in effect after the effective date of USMCA. So if the entry into force date for USMCA is July the 1st, it's possible, we're pending advice from the U.S. Trade Representative, but it's possible that the goods will still qualify under NAFTA. And in that case, you would use the certificate of origin 434 that you're used to using. Post USMCA, you should not use that form 434 because that is a specific regulatory document for NAFTA. You can use a form that's in substantially the same shape and appearance as that form, and that might be easier from a standardization process to help your customers understand exactly what they're looking at. The people that were doing NAFTA are going to be the same people that are doing USMCA, so they're going to be used to seeing a certain type of document, and mirroring what you did before is probably a healthy decision from a customer relationship standpoint. So I would recommend using a similarly constructed document. Rule 4A for sections 1 through 27. Okay, so let me go back to that section. So these are exceptions to the de minimis rule. In Annex 4A, there are exceptions to the de minimis rule for chapters 1 through 27. It goes A through K basically in Annex 4A, and it grows in tariff. It goes along with the tariff. So 0404 I think is the first one under 4AA, and then it goes onward from there down to chapter 27, where it introduces some specific exceptions to the de minimis rule based on certain product types within those headings or subheadings in there. And it's only 10 or so rules. It's not that heavy of a lift if you have one of the items identified in there. Effectively, it's saying that if you have non-emerging material that does not change at the subheading level, you may not count that towards the de minimis rule for products of chapters 1 through 27. Okay, what questions did I not answer? We're only at 10:40, so we've got time. Feel free to continue submitting your questions. Those of you that have everything you need, feel free to hop off. I actually would like you guys to send your specific questions in. I'll try and answer them to the best of my ability, or one of the people on my team will. And if you want some of our templates, again, they'll be produced within the next couple of weeks. As we get more advice from the trade representative, we're holding off on allocating our resources to making stuff that might change. But as time goes on, we'll have those templates ready, and we'll put your name in a queue so that you get a copy of them.